Gold in US dollars, or as we like to say around here more explicitly, gold in fiat Federal Reserve note terms, continues to build further momentum for an eventual breach of its old August 2011 nominal price high of around $1,900 per troy ounce. Whether that happens later this year in 2020 or in the coming years and months, it's not our task to predict. But we as bullion buyers ourselves, we see $2,000 gold as an upcoming gimme, a future supportive price point whose seeds have already been sown. Late last week here on SD Bullion's YouTube channel, we showed viewers various gold price charts around the world, some which illustrated hundreds of fiat currencies, denominated gold values, and if you missed that, stay tuned to the end of this week's video and click through to see those confirming gold price chart breakouts in other major fiat currencies for yourself. This week, we want to focus in on historic US stock market downturns, and mainly examine them through valuations and performances of gold and silver. And while we'll take a brief look back at gold in US recession history, we'll mainly focus in on the more modern, supposed free trade and financialization era, what we like to more explicitly call the full fiat currency era, which is now nearing 50 years in duration. Hello, this is James Anderson with SDBullion.com. And today we'll look back at US stock market downturns through the eyes of gold and in more modern times, silver too. This is a graphic provided by Google, illustrating online internet search volumes from 2004 to present day 2020. You can see some obvious spikes in search volumes on the right-hand side. All three of the largest ones peaked during recent stock market downturns. Some of these US stock market downturns, like in late 2018, came very close to triggering a formal bear market in stocks, which is defined as a negative 20% nominal drop in value. Given where we are in historic S&P 500 nominal terms, it's completely understandable why there are many jittery stock market investors out there, some of whom are very near retirement age, many of whom are leveraged on margin or money loaned to them to buy stocks which is not even theirs, some of which are playing a risky game of keep going up stock market. Going way back to our nation's founding and then their split up some near 90 years later, there have been many times in which steady or even rapidly escalating silver and gold values have helped U.S. citizens preserve their purchasing power, and to at times get caught up in price manias that eventually busted and came back to perhaps fair values. Late in the U.S. Civil War, the silver price more than doubled, and in the economic recession that followed the U.S. Civil War, the price of gold nearly eightfolded in U.S. dollar terms, going from $20.67 per ounce to as high as $160 by the late 1860s. By the end of the 1920s, stock market mania, peak to trough, the U.S. stock market lost over 90% of its nominal value into the heart of the 1930s Great Depression. The price of U.S. citizens' confiscated gold went from the $20.67 they were paid for handing it over to their local Federal Reserve branch in the year 1933, only to have those same dollar bills devalued to gold by some 70% with a new arbitrary $35 an ounce price by fiat decree in 1934. Now that was an arbitrary fixed price, which, looking back, based on the amount of US dollar notes in circulation then, was way too low and likely extended the deflationary depression then ongoing. The financial powers that were tried to maintain that too low a gold price artificially, only to have the London gold price rigging scheme fall apart by the late 1960s. As promised at the start of this video, we're going to focus in on the last 5 decades of time. From just past when the US and then President Nixon went full fiat currency, breaking the final ties of Bretton Woods Agreement, we are going to specifically look at how gold and silver fared during its 2 major secular bullion bull markets spanning the 1970s and within this 21st century. We will specifically hone in on 3 U.S. stock bear markets and 1 major stock market decline. How did gold and silver fare during such durations? The first stock bear market we're going to look at, early 1973.
European government exchange markets were closed today, but in unofficial trading, the dollar continued to plunge. In hopes of halting the new money crisis, the 9 common market countries plan to meet this Sunday in Brussels. In view of President Nixon's assurances that the dollar will not be further devalued, the European statesmen may decide to float upward to their own currencies, and that would have the same effect. For a look at the situation in Europe today, we have reports from John Lawrence and John Sheehan.
The government banks of Western Europe may have been closed, But the commercial banks, like Midlands of London, were busily buying and selling foreign currencies today. The dollar continued to drop. London bankers blamed the new crisis on the old problems. The huge surplus of billions of dollars surging around Europe. Panic selling by speculators, big institutions, and Middle East oil millionaires. And a growing lack of confidence in paper currencies, not just the dollar. Bankers are beginning to express deep concern over the consequences should the present trend continue. For the second time in less than a month, the finance ministers of Western Europe will find themselves hard at work again this weekend. The present system of foreign exchange dealings is in serious trouble, and last month's devaluation of the dollar was not enough to correct it. John Lawrence, CBS News, London.
From January 1973 to the end of 1974, the S&P fell by 43.4%, while gold ran from around $66 to just under $200 per ounce, a tripling in nominal terms. Silver ran from $2 an ounce to $4.75 an ounce by the end of 1974. Next stock market downturn began in the fall of 1976 and nominally bottomed out in the spring of 1978, a nominal drop of nearly 20% in about a year and a half of time. While the S&P 500 bounced with some nominal increases in the months that followed, it mainly moved sideways into the early 1980s, while gold and silver mania phased. From the fall of 1976, gold went from about $120 an ounce to peak over $800 an ounce in the early 1980. Silver ran from $4.34 an ounce to near $50 an ounce, and the Hunt brothers inevitably got scapegoated as commodity price explosion poster children. Moving on to this 21st century bullion bull market, the first internet bubble began its rollover in March 2000, and it would not stop devaluing until October of 2002. While over that time frame the S&P fell 49.1%, the gold price in fiat Fed notes went up nominally 12.1%. With the over 120 million ounces of silver sitting with Warren Buffett's Berkshire Hathaway, it only lost about 14.3% in nominal terms, going from $5.09 an ounce to $4.34 an ounce. The final and last stock bear market began on October 9, 2007, and it didn't end until early March 2009, nominally falling over 56.7%. Gold during that time frame was up over 28%, and its early March 2009 price of $930 per ounce went on to more than double nominally within 2.5 years. Silver, while very volatile throughout this stock bear market, ranged from highs of just over $21 an ounce in early 2008 to a low of just under $9 an ounce spot in late 2008. It stayed relatively flat during the round trip of this 2007 peak to 2009 trough for the S&P 500. Silver started at just around $13 an ounce and ended right around there too, only to nearly quadruple in price just 2 years and a few months following. I personally worked on the front lines of the wholesale and retail bullion industry at the time. During the most acute phase in the late fall of the 2008 financial crisis, both precious metals outperformed their respective spot prices due to shortages in deliverable bullion products for many months running. Gold bullion products had upwards of over 20% premiums for 1 ounce gold eagle coins, and silver eagle coins peaked with nearly 80% premiums above the then silver spot price in November 2008. While there were many bullion dealers and mints at that time, they had nothing to deliver and only promises to sell. Most likely looking ahead, the Federal Reserve and the U.S. Treasury are going to keep devaluing the fiat Federal Reserve note to help mask the losses in purchasing power that S&P 500 investors will lose measured in gold and silver bullion in the coming years. If our fiat future rhymes at all with our full fiat past, S&P 500 investors stand to possibly lose 10 times in value versus gold from here to potentially there. Of course, no one knows the future, and that is precisely why bullion buyers acquire and maintain prudent allocations to physical precious metals these days. Will this current virus be the black swan that brings on a global and U.S. stock market recession? How far will fiat currencies have to devalue versus gold before general confidence in them gives way to runaway, get me out of these currency price inflations? Time's only going to tell, and we will hedge our bets accordingly. That's all for this week. Stay tuned for some other video updates we recently made. If you enjoyed this content, be sure to give our video a thumbs up. If you're not subscribed to our channel, do that. And finally, be sure to hit the alert button so you don't miss these market updates as they come along. Give us your comments below. Let us know what topics you want to see more coverage on.